So everybody, thank you so much for being here tonight. I'm so excited to be here with four really incredible panelists. We're all really lucky to be able to get to learn and hear from four tremendous people in the industry who have built really incredible businesses over the decades. Everybody knows Sabbagh, Paul Massey, Ezra Dweck, and Stephen Hidary. I'm gonna ask some questions I prepared, and then we'll open it up to the crowd for some questions afterwards. So feel free to start thinking about what you'd like to ask the panelists. All right, so guys, thank you so much for being here. I'll ask a couple of questions that could be for everybody. I'll kind of highlight which ones are more for everybody and which ones anybody who just wants to feel free to take them could. So first, let's talk a little bit about the pandemic. Obviously, the entire world kind of turned on its head, 2 years ago when the pandemic started. But it also, aside from just really changing the whole world, really changed the real estate landscape. So if everybody could just kind of talk about how the pandemic affected your specific businesses and how you successfully, or even any challenges that you've had that you're still potentially dealing with, how you navigated through it, that would be great. So we can start with Mars.
Do I use this microphone?
Sure.
Oh boy, we got problems. Okay, hi everybody. Hey Uncle, what's up? Let's go back to, what is it? May 2020. April, May 2020. I'm gonna paint the picture for everybody just to give you some understanding. So at KSR, what we do, amongst other things, we do retail leasing and we sell buildings, okay? Focus on that for a second. May 2020, can't go into our office. So now imagine retail is shut down, buildings are shut down. I'm calling up a retailer, hey buddy, I have a space for you that I can't show you, and if you're dumb enough to take it, you can't operate out of it. But hey, want the store? Horrible sales pitch. And now same thought process. Hey buddy, I got a building that you can buy, can't show it to you. I'm sure there's no bank dumb enough to give it to you or give you a loan. And I'm certain that nobody's gonna tenant it, but do you wanna buy it? So kind of wasn't a fun time, to say the least, I would say. But during that time, the world changed and things changed with it. So I remember it was the last day in our office that we were legally allowed to be in the office. And at that point we had, let's go 50% attendance. And so now at that point I said, you know what, we're gonna do a Zoom and connect everybody so we could all communicate and still feel like one and work together and integrate. Great. While we're on the Zoom, one of my partners in retail, Abel Manopa, tells me, do you mind if my brother-in-law, Bobby Ajmi, comes on the Zoom? Okay. So we did a Q&A with Bobby for like 2 hours, and it was awesome. And then we're like, all right, you know what? This is our path forward. For 90 days straight, we had a Zoom with a different business titan in a different industry. Every single day, 2 hours a day, I had a button down with my underwear that you couldn't see, Cheerios on the left side that you couldn't see, and I did a Q&A for 2 hours every day. And I asked similar questions, and it's wherever the combo took us, but the main question was, what's next? What are you pivoting to? What do we do? Retail sucks, sales sucks, we need to do something. And we saw a lot of recurring themes. Recurring theme number one was industrial. So all right, 50% of the people over the 90 days said they're pivoting into industrial. We now do industrial. I'm telling you, if you asked me a question about industrial at that point in time, I didn't know a thing, less than a thing. I was negative information, but we plowed into it. And at this point, I think 85% of what we sell is in that space. We pivoted heavily into that space and we dove right in, and that's what we focused on. And then on the retail front, we actually did the exact opposite. We doubled down in New York City. While everybody was sleeping, we said, you know what? We're gonna take the time to try and cultivate all these relationships that we normally can't. In a good cycle, it's hard to get business. Everybody leases, everybody sells, everybody succeeds just because the market's hot. But when the market goes down and nobody's there, that's when the business really comes. Because that's when you can talk to an institutional type landlord or seller and say, I'm here, all the people who you normally deal with are not here. I'm gonna kill it for you, I'm gonna work, build a relationship, talk to them. And then when the floodgates opened, and they did, and the city opened up, we were there, boots on the ground, ready to grow, and we doubled down in that space. So I can tell you that the pandemic really threw everything on its head. There were tremendous shifts that we took advantage of some and not others. Like a lot of people shifted into multifamily, throughout the country. Awesome, good for them. A lot of people shifted into industrial, which thank God we were the benefactors of. And for us, we doubled down in retail. And coming out of COVID now, I guess we're still in COVID per se, but 2 years later, looking at it now, our whole business changed. I mean, we used to sell New York City, now we do, but predominantly we sell Jersey, PA, Miami, and etc. We used to do predominantly more boroughs leasing, now predominantly we do high street leasing. So we changed as a company for the better, thank God, and I'll just say thank God to Hashem, better lucky than smart. Or you know what, if you want advice, listen to people a lot smarter than you and just follow them, because that's really all that we did. And that's what we did during the pandemic. So it really threw us on our head and allowed us to come back a lot stronger and a completely different business that we probably wouldn't recognize ourselves 2 years ago today. Thank you.
Really incredible. It goes to show that certain things that might seem like a huge challenge at the time really can be a blessing in disguise. We'll hand it off to either Ezra or Paul or Steve.
I was going to say Morris and Abraham are both lucky and smart. That's
You know what, I'll take lucky before smart and dead.
So Morris, Ezra, Steven, it's great to be here with you guys tonight. And Eddie is a new member, a new and fantastic member of our team. So we have a company that sells buildings and finances buildings, and there's a bunch of friends out here tonight. So it's really great to be here. And we had a similar experience. It was a complete shutdown for 6 months when the pandemic hit. You all lived it, so you know we probably don't need to spend a lot of time on that. But I think what's happened is that it's by asset class in a way. Offices, everyone's wondering whether we're going to work from home forever, or a bunch of people are. I think it's a complete fad. I thought retail had hit bottom pre-pandemic, and that technology had killed off every tenant that it was going to, but yet we have a new hitch down. Industrial is the new amazing thing, but it's New York. It's going to come back. I think that on the retail side, these personal services tenants that survived are going to thrive. Restaurants are going to come back, and we're super optimistic. If you think about the last 2 years, in New York City, there are 3,000 building sales every year. And that's a small number of the total universe because it makes no sense to ever sell. By the time you pay federal, state, local capital gains, city transfer tax, state transfer tax, broker fee, legal fee, you walk away with 65 cents. Any bank will give you 65 cents. So rationally, economically, you would never sell a building. So you would refi every 5 years. That's what the world is in New York City. But what has happened in the pandemic, like a recession, where people freeze up because of uncertainty, we had 1,400 sales out of 3,000 in 2020. We had 1,700 sales in 2021. So blended in, we're at half speed. That means that 3,000 people put off settling their estate, postponed retirement, delayed wrapping up a partnership they need to delay. So we think, Eddie and I think, and our friends, that 2022 is going to be a year of rebirth, people coming back, transacting, moving life forward. Because again, it's not economic. Economic rational behavior in New York is why would you ever sell? So from our seat, we're super optimistic, and we love this place. We love New York. I'm an immigrant. I came from Boston, and I got a. Yeah, nah, it's complicated. I used to tell people I'd just as happy to go to a Yankee game, and I had a partner in my first business who was still my best friend, Bob Knacklin. He says, "Don't tell people that. You sound like a freak. You were born there." But anyway, New York's New York. It's always the light to the mods. The young people are going to come here. We all love the diversity of New York, and I think New York's going to be great.
Thank you so much, Paul. Ezra?
I thought there was supposed to be like 30-second answers to these questions, so if I seem a little wing, you'll understand why. So first of all, it's really an honor to be on this panel. Paul's a legend. When I need advice, I call Morris, so I mean, you should listen to him more than
He's
me.
being very humble, he's lying.
And Steven's like, we're brothers, basically. So, it was an interesting experience. We had this guy, I don't think so, I have Shai here, who's been with us for a long time. Where's Lee? I saw Lee. Lee? There you are, Lee. So, we had this guy who we worked with, and for people who don't know, we're lenders. We give out money to investors for 1 to 4 family homes that they're buying, fixing up and gonna rent out or sell, and for small multi-family buildings. Typically, what we had been doing till then was we were selling those loans to institutional note buyers, right? That was a big part of our business. One of he was the chief credit officer at one of our institutional note buyers in January of 2020. He said, look guys, he said, I want you to know, you don't know this, right? He said, I want you to know, you know what I'm talking about though, that there's this virus in China. It's going to change the world. He said, if you don't do another loan for the rest of January and February and maybe March, he said it might not be a bad idea. So that's our new head of credit. We hired him right after that. He's now internally helping us see where the world is going.
And the question is, wait, hold on, did you listen?
So we were.
You didn't
no,
listen.
we didn't
The
listen.
answer is no.
Where are those
Now-
loans?
Now we gave him veto rights. Now he has veto rights on the stuff we do. So, and that's actually our head of credit. So that was just an interesting intro to that. It was really terrifying. So for like you guys here and mostly guys, right? 2 young women. It was very scary, right? You have a career and you built it and you have a family and you have kids in yeshiva and all of a sudden, hey Billy, everything stopped, right? So we spent a few years before that really building a business, me, Joe Obed, the rest of the team, and everything stopped. It wasn't like Morris where we were trying to convince people to take a lease. That it was over. We were not originating a loan. Not only that, the governor told everyone, hey, nobody has to pay their loans either. So I told my wife, I said, be ready. I said, I'm hoping everything will be fine, but life might change dramatically for us in a financial way. So why are you so negative? I said, I'm not negative. I said, I'm hoping everything will be fine, but it could not be. So I think, but be ready. So I think one of the things for me was just learning, again, resilience and saying, look, here's where the world is today. We're going to pivot to wherever it is. And we worked hard with our institutional partners. We had money coming in every month. So I just say that everyone was told they didn't have to pay. Most of our borrowers still paid, so we had money coming in every month. We had built a strong team. So we decided we weren't going to gut the team. Instead of taking what we thought were going to be our profits, we took that money and paid our employees. Thank you for PPP 1 and PPP 2. That helped a bit, but not. People were making more than that. So we said we believe it's coming back. And what we did was, at that point, we said, and we had been planning for it before, we said this is the time to raise money. We actually planned before that. We said in November, we hired someone to raise a fund for us. We said eventually we want to have more of our own capital to deploy and not be dependent on the institutional note buying and institutional relationship market. And if we have our own dedicated fund, that is going to be amazing. And it's funny because I had a loan that someone brought to me, and everything was pretty much stopped. Someone brought me a loan, and it was a 30% loan with a great borrower and a strong interest rate. And I called up the institutional guys and I'm like, hey, if I have a no-brainer loan, would you are you guys in?
Crickets.
They said, it's a no-brainer loan, we agree, we're out. So I said, this is like, there's, I don't want to say blood in the water, but they say, what is it? It's Warren Buffett, he says, when people are greedy, be fearful. People are fearful, be greedy. So we went out in like the summer of 2020, and we went out raising a fund. And one of the guys who told me before, he said, when you guys are ready for a fund, I'm gonna give you $2 million. And I went to him and I said, we're raising a fund. He said, are you crazy? Raising a fund? I said, there's blood, there's opportunity, there's blood in the water. I said, things are starting to come back already, we see it. I said, we're gonna do no-brainer deals. And he's like, okay, I'm out. But what we did is we raised a fund, and that was our first raising, our second fund. And so I think we just, we continued, we supported our borrowers, we let them know like, hey, if you're having a hard time, we're still behind you. We work closely with like our institutional partners. And then I think I did one of Morris's talks. I know I was like a spectator on one, I may have spoken on one of the two. I don't
And
think
when you go into lending, so that's a good thing.
I think the guy who was supposed to be on his talk canceled, and they said, "Oh, we need a quick backup. Are you available?" So I was available, and
Also not true.
and I think that was kind of our reaction. And finally, look, at the end of the day, we didn't gut our team. We could have said, "All right, we're going to take this money and reap profits," but we said we're going to keep our team together, and when things come back, we'll be positioned to really hit the ground running. And thankfully, 2021, we were, we beat 2019 by a lot, so it's great.
Okay. All tough acts to follow, but I'll give it a shot. So I think the pandemic kind of, 3 lessons I'd say from the pandemic as it relates to our business specifically and maybe generally to the real estate industry. So Paul mentioned before asset classes and how they're each impacted. So one thing we didn't mention yet on the panel was the hotel industry. So the hotel industry is something that really hasn't rebounded yet, and there's a huge question mark hanging above how that will rebound. And a lot of the hotel business is dependent on corporate travel. People encourage their employees to travel, not Zoom, and to meet their clients, and that's essentially what drives 50% of hotel stays in New York City and other major cities across the country and even the world. That's essentially at zero today. Yes, resort travel and leisure travel is up because people are working from home and they do have more time, so they are getting out a little bit more, but for the most part, corporate travel is dead, and I think that's going to be a huge question mark moving forward. And for our business, we've traditionally done a lot of hotel development and hotel operations, and we were actually in the ground with a few projects as the pandemic was hitting, which were paused and are still paused as there is more clarity around that. Speaking about lending, lenders today, because of this lack of clarity, are not necessarily going to jump back into that game so quickly until they see that the trend of travel continues upward. And it's not something that necessarily happens like a light switch or flips on like a light switch. It has to happen over several quarters and over several years, and they need to see that that it's really trending towards in the right direction. So I think we'll see how that plays out, but we're optimistic. 2 is the pandemic really, unfortunately, exposed the safety concerns that we had in our city that really set us back. And not just set us back the years of the pandemic, but I think set us back a few years more than that. We suffered, right? And we're still feeling the impact of that today. Yes, the recovery has been tremendous, and I share your optimism for 2022. It's going to be a tremendous year in 2021, built on 2020, but you walk in the streets of Midtown, and there are things that you still don't want to see, and that's going to impact the retailers, and that's going to impact the business corporations that need to convince their employees to take mass transportation and come back into the office. So we're all optimistic and hopeful that Mayor Adams and his team is going to turn things around. But yes, that whole side of the city was exposed during the pandemic and had a real impact on the real estate industry. So let's see how that plays out. And number 3, I think the micro economics of a deal I think changed during the pandemic. And I'll give you a quick example. Multifamily, super hot segment today. When you look at multifamily, 2 of the hottest areas in it, it's easy to say, I want to buy a rental building. Most people don't want to buy rent stabilized buildings today. 2019 rent laws put a real damper into how you could increase rents and incentivize landlords to renovate. But when it comes to oversized units, either rentals or condos, where families have more space to spread out, those are very, very enticing, and they're going for premium prices. So again, on the micro level, people are going to overpay for that stuff. Investors are going to buy more of them, and end users are going to buy more of them or rent more of them. Similarly, studios. We own a bunch of studios. We're seeing rents today 20 or 30% higher than they were in 2016, 2017 when the market was hot.
Wow.
Higher, right? Why? People are saying, I don't want to live with anybody else. I want my own space. Maybe I'm a student, maybe I'm from out of town, maybe my parents live locally in Long Island, I just want to get out of the house, right? I want to wake up in the morning, I don't want to see anybody, leave me alone, I'm working from home, or maybe I'm going to the office a few days a week, but just let me chill. As opposed to, let's get a bigger space, let's get a 2-bedroom and I'll share. No, not into it anymore. I think that's another trend that we might see continue. So different things that we learned, and I do still think there's going to be more things that we learn as we go into 2022 and 2023 and the city really rebounds.
Fantastic. Thank you so much, everyone. That was really insightful. We'll shift over to a couple of questions where I'll just let whoever wants to take it. It might, it might apply more to certain businesses and to some of you guys more than others. So the next thing we'll talk about is 421A. On June 15th, the popular 421A tax abatement that's really commonly used by multifamily developers in New York is set to expire. So Governor Hochul has proposed a new similar program called 485W, which for a while was looking likely to be enacted. Now it's a little bit more shaky, and we're not sure where it's going to land. Could you, whoever wants to take this, could you talk about what your perspective is on the expiration of the program and how you see it potentially changing the industry going forward?
I pull on you.
Okay. So the real estate board, powers that be, have written off 421A from 6 months ago. They've factored it in. They don't believe that, I'm not speaking for the board, but they don't believe, we don't believe that it's not in the budget. It's not in the plan right now. And no one thinks it's gonna be until the end of the year, at least. So I think, unfortunately, it's dead. And in simple terms, just for folks who aren't in the land selling business in New York, if you enter into this program as it used to exist, and it's sunsetting in June, you need to have a foundation in the ground and be building. You abate taxes for a period of years, 10 years, 15 years, 20 years. And that abatement of taxes means that a lot of the profits from building a rental building could flow through to you, and you could pay for the land. You could afford to pay for the land. Without the abatement, with construction costs as high as they are, the value of land is in the basement, near zero. Near zero, right? So based on what it costs to build a building, you can't pay people for the land, and you can't build a building. So it's really, really bad, because a lot of what's going on in New York right now with the rents being at record levels is there's a massive housing shortage. We have, actuarial tables will tell you that another 1 million people are gonna show up in our city in the next 5 to 10 years. If you do the 2.4 person per family math, we need 400,000 housing units just for the growth of the city. And our housing stock is 80 years old. So a lot of it's obsolete. We need to rebuild that. Unless there's a
We
program.
have 20,000 units in the warehouse.
Yeah,
Also,
well,
on top of that.
because you can't raise rents. Who wants to rent an apartment? You can't, the rent laws of 19, and I'll be more direct, say you can't raise rents, period. And you can't spend money to fix up a unit and pass any of that expense through to your tenants. So the legislature in Albany is flipped to Democrat in 19. And I'm not making any political statements, but it was payback time for the Republicans. Okay, wealthy Republican real estate people, or any wealthy real estate people, we're gonna create equity now by crushing your value, crushing your ability to make money. It makes no sense. No sense. We need housing in this city. We need development in this city. But anyway, long story short, 421A, you get the basics of it. But politically, it's toxic. It's not gonna come back until at least the end of the year. And then it will be obvious to people that we need housing. The other thing that happened with the rent laws, if you had a $10 million apartment building, whatever, you know, and the rent laws said you can't raise rents and you can't fix up your building, that turned that $10 million building into a $6 million building where you were buying it on a 4% return, driving it to an 8, which is great. That's a great business plan, right? So the rent laws turned it into, okay, now no one's gonna pay you 4% return. You're probably gonna have to sell it for 5 or 6, and inflation is gonna drive it back to 4. Who wants to buy that, right? No one wants to buy that. So it automatically, radically devalued the buildings, and if you think that 40% of the city's $100 billion revenue comes from those buildings, when assessed values start to tank, there are gonna be budget shortfalls, which are being perfumed over right now by federal funds from the pandemic. We're gonna start feeling this, and then the politicians will be like, oh, we totally crushed ourselves. And there'll be a reversal. So we have a lot of big clients now who are going deep into buying stabilized buildings in bulk because they think it's impossible that the city doesn't reverse these irrational laws. So watch what happens. It's going to be really interesting, but at its core, to be all living together here and to have not just rich folks, but folks who need our help be able to afford to live here, we need to build housing. We need to build it
So
badly.
there's a book by a economist. His name is Dan Ariely, I believe, and it's called Predictably Irrational. Before your friends continue to buy rent-stabilized buildings, assuming that eventually the legislature will turn rational, I'd have them read a little about that. So I have a little bit of a take on the 421A. So we do a lot of loans where the developers are dependent on 421A. So I'm conservative in some things, liberal in others, but I can do math. So I think that 421A sometimes is a giveaway, right? So if you have a
57th Street.
value of land, I'll just say value of land, right? So you guys learn a term, if you don't know yet, NPV, right? Net present value, you take like your basic finance courses, like what is the money worth today, right? What's the value of your tax abatement? So the abatements have a value. So if you have a piece of land, piece of dirt that's worth $1.5 million today, and someone's calculating the abatement's worth $800,000, all you did was enrich the guy who's selling the building, because there's enough value there where someone else will say, hey, it's worth $700, I'll buy it for $700, I'll build a building on top, right? The thing is when you go into negative, or you have people that start to warehouse land, which is an issue. For me, where I see it, where it's interesting, where they're not really talking about, is you have these 3-family houses in the Bronx, and a lot of developers are taking these 3-family houses and turning them into 20-unit housing. And for that, it's not empty land that is going to do something with it. No, it's a 3-family house, it's income producing right now, they can just sit on it and leave it forever. But that's where, to me, the tax incentive says, okay, you're in an area that needs the housing, you're going to add 14 units, we're going to abate it, and you have real housing that's being created, as opposed to, what was it, 57th Street? Or
Yeah, but the difference with that is that in the 429A, you get 30% affordable.
They're all affordable. All the units are affordable.
The Bronx are affordable, but nobody's building in Brooklyn or New York City that's
Look,
affordable.
people complain about, so for me, affordability is driven by supply.
Also true.
Right? So like the cure for affordability is just having lots of supply. These guys are just printing houses right now and printing apartments. And I think the more of it there was available, the better it would be for the city. They talk about losing tax revenue. There is no tax revenue. It's like talking about, now we're not giving tax breaks to Amazon. So now what do we do with that money? That money's not there. It doesn't exist. So similarly, when you don't build the building, you're not going to get the tax revenue for that building.
It's true. It's an interesting take on it.
I think it's interesting. It'll be interesting to see what happens with foreclosed eviction, which also impacts the housing stock.
You gotta explain it to them.
Foreclosed eviction is another piece of legislation that they're talking about in Albany now.
Which is horrible.
Also, just a step back, state rent laws are controlled, rent laws in the city are controlled by the state. So the Assembly and the Senate and the governor up in Albany control everything here in our 5 boroughs and in other municipalities around the state. So what they're talking about now is a free market unit, what we know currently as a free market unit, potentially having a rental cap on it. So you can rent the unit for $3,000. The tenant, after 12 months, gets offered a renewal, and in a free market society, that $3,000 could go down to $2,700, go up to $35, $36, whatever the market could bear. Under this law, it would be capped. They're proposing 5%, I believe, or CPI, or
1.5
percentage,
CPI,
or
yeah.
1.5 CPI percentage of inflation. And obviously the real estate community is pushing back hard on that because, again, it is a form of a regulation which disincentivizes investment into property and will severely impact a lot of landlords' decisions to invest in their buildings and make the housing stock better. I do think that these issues are going to be connected. I ultimately think the legislation is going to pass something that is going to be, that real estate is not going to take advantage of. And unfortunately, we're going to need to wait a year or two to realize it, right? They're going to run around town, look, we passed, we renewed, they're going to give it a fancy name, 485, 486, whatever, I add a W, take it on, it doesn't matter, right? And no one's going to build. No one's going to build. And like you said, 1 million people in the next 5 to 10 years are going to come in and they're going to have nowhere to live. And then someone's going to wake up one morning and say, what are we doing here? Let's see when it happens.
All right, let's move on to interest rates. We'll probably only have time for maybe
Z.
2 people. Yeah, definitely Z. We'll probably only have time for maybe 2 people to take this, obviously including Z. So, you know, we've known.
Shai wants to take this one, please. He's welcome to.
So we've known for a little while that interest rates would be rising coming up this year, but we didn't know just how quickly they would be rising, and that's kind of taken everybody by surprise, just what they've done over the last month or so. You know, everybody, especially everybody from IceCap, can tell you that they've really been rising quickly. So my question is, how do you guys see these rising rates affecting the commercial real estate industry in general, and specifically your businesses if they do? Whoever wants to go first.
Yeah, so if everyone takes a look at Shai Galapo over there, I predict that within 6 months he's going to have a lot more white hair. So the interest rates have been, I think that you guys see like the Fed raising rates, it's predictable, it's out there, okay, there's a 25 or 50 bip raise this coming up this month, and next month there's gonna be a bunch more over the course of the year, okay, it's kind of like you know what's coming. That's not the interest rate rises that we are experiencing. So we're getting that, and everyone sees like, oh, it went up by 25 basis points. But then we're seeing risk premiums spreading dramatically. So I'll keep it non-technical. 4 months ago, we were giving out these investor term rental loans. So a guy buys a single family house and he wants to rent it out and he wants a mortgage on that. So we were giving those mortgages at $375. Billy was happy, Lee was happy, Shai was everyone's hero, and we're giving out this mortgage at $375, so it's 30 years fixed at $375. Those rates have been, for the last month, going up almost every day. Like we have a loan that was quoted yesterday, a day ago at $375, it's gonna be 4, and it's $425, then it's $450, $475, 5. 525. Okay, 525, that's the new normal. Oh no, 550. 6, okay, at the beginning of the week it was 6, now it's 650, 675. It is going crazy. People, you're seeing the short-term rates going up. It's, the risk premiums are spreading. I think that people are underestimating. I see people planning their refis at 4.5%, and figuring they're gonna get a 70 LTV loan, on a 5 cap. That's their exit plan. I think they are in for a rude awakening. I posted a model on LinkedIn. I'm like, guys, I think you're all making a mistake. Use the model, figure it out. Your rates are going up. Your cap rates are going to go up. Make sure you're safe and not going to have to hand back keys to the banks. So I think there's going to be pain, even if the values are there. People are going to have to come out of pocket to refi, and I think that I speak to my capital markets guys about cap rates, and you can address that better than I can. But they say there's like how lightly correlated they are. I don't believe that at all. I think that cap rates are going to move because if you can't get financing, if you can't get 70-75% financing, you don't want to be in for 50%. Your equity can't be 50% because you're not going to make enough of a return. So for me, cap rates are going to move. There's going to be pain, and don't buy 4 caps.
That's smart. Hold on, to make it simple for the people that don't understand, I'll just keep it simple. When interest rates go up, prices go down. When interest rates go down, prices go up. Okay, so just everybody understands that model? And I'll explain to you another interest rate thought process. The longer term the interest rate is, usually, right? You have a 5-year, a 10-year, a 30-year. The 30-year would cost you more money. It's a higher interest rate than the 10 or the 5. So now for the first time in how many years, they went like this. The 5-year costs more than the 10 and the 10 more than the 30, which any economist and Zeke can tell you, red lights, recession, which means things are going to go sideways. What they're telling you in English is they're telling you that people are saying 5 years from now, you're going to be worse off than you will in 10 years or 30 years, which is usually the opposite way around. If you want my money for 30 years, you got to pay me a higher return, a higher interest rate. 5 years, less of a return. Now it's the opposite. And what Z's saying that it's going up every day. So what a cap rate means.
These kids are 20 years old.
I know.
Give them something optimistic. Don't let them.
No, let them know, because when in downturns you make more money. Let's just make this clear. You will make more money in a downturn if you are smart than a good market. Fact. Right? People like to ride the waves, but at the end of the day, the wave crashes at some point. If you're the guy buying down, then it comes back up. You make a lot more money than the guy who's buying like that, and it goes like that. So the point is a cap rate, what it means is, it's a capitalization rate on your net operating income, on your net ordinary income to what you buy the building for. So simple math, if you're buying a building for $1 million and it has a 10% capitalization rate, you make $100,000, right? So what Ezra is saying is very simple, is that if you pay 5% on your loan, you can pay X dollars. You could pay $1 million. That loan goes to 6%, you could pay $900,000. 7%, $800,000. So the point is, real estate's always 6 months behind, unfortunately, especially with the rates and the way they're moving today. But at some point, the party's going to end. And the party is ending now. Because if you're buying something at a 5 cap and your interest rates go above a 5 cap, okay, 5% return you paid, your interest rate is 5.5%, you lost 0.5%. Lost money. That means that every month you will have to come out of pocket. And that is a pretty bad investment. So the odds are there's going to be a lot of blood, a lot of people, unfortunately, that are going to be in pain, and there's going to be a lot of adjustments unless things stabilize, which is probably unlikely happening anytime soon, given that the Fed, said they're going to have 6 more rate hikes by year's end? 6 more rate hikes, okay? We're in April. 6 more rate hikes means almost every month you will have an increase in the Fed rate. The odds are they won't all be a quarter, they'll probably be 50% basis points and quarters, so which means a year from now, rates will probably be what? For him, they'll be 8-9%. For your home, you'll be in the 4s or 5s likely. Where today, you're in the 3s going to the 4s already. So it's not sustainable, and which means that there will be blood. So hopefully you guys are smart enough to take advantage of the opportunity.
All right, we'll move on to the next.
Sorry, I'm not optimistic like you. I know, maybe
You're
I'm
optimistic about
optimistic.
making money in whatever market you're in. So that's, I'll give you that optimism. So.
Thank you.
There you go.
All right, let's move on to the last general question, then we'll do a couple of questions specifically for each panelist. So we already alluded to the 2019 rent laws that are very strong and have had a very big effect on the industries in New York. So those laws have made life really harder for landlords and made it very hard to evict any non-paying residential tenant. So one of the results that we're seeing of that is that a lot of traditional New York investors are really starting to flock toward the Southeast. We're seeing guys who used to buy a ton in New York really looking only in Florida, Georgia, South Carolina, maybe North Carolina, maybe Texas.
Red states.
Yeah, that's a big part of it because they're not passing those laws. So I'm curious to hear, whoever wants to take this, your perspective on that trend and your opinion on the ultimate strength of New York, which Paul alluded to before, specifically New York multifamily, in the long run.
Want to take it? I'm gonna be the Debbie Downer, you don't want me to say.
I have things to say also, but you and I just spoke a lot, so.
You want to start? Okay, I'll be quick. I think it's a trend that is here to stay because corporations are moving to those states as well because they are more tax friendly to them. And when corporations move, they bring their employees with them. Those employees need housing, they need retail, they need the amenities of those cities. Those cities are poised for growth. Our firm has been active in South Florida, in Miami. We're seeing tremendous growth there and many opportunities. And we're also looking in other states that tend to lean red for a lot of those reasons. So I do think we're going to see a lot more opportunity there. In terms of New York is unique that it has a tremendous talent pool, mostly in the tech and healthcare industry, that I believe is firmly footed here and is not necessarily running away. And because of that base, and in many other industries like finance, New York is here to stay. Despite a lot of the negativity that you may be hearing from us here on the panel, like we mentioned, that I alluded to before, rents are up tremendously in rentals and in retail as well. And there are a lot more retailers looking for new spaces. Morris would confirm this on the street today, despite the homelessness and the crime, because New York's eternal. People are looking through a lot of that and is saying they'll be here forever. So I, yes, agree, red states will continue to grow, the corporations will continue to move there, but at the same time, places like New York City will always be places like New York City.
Absolutely. I have, go ahead.
Yep. No.
Oh, well.
One of the things that happened in the 08-09 recession that made an impact on me was Google bought its first big New York City building for, I think it was $1.5 billion, roughly that. This year they bought their second big New York City building for $2 billion. Amazon's building one of its headquarters in the old Ward and Taylor building on 38th Street. It's a massive building. Clearly they're investing and those are just two companies that are like making big investments here. So I think smart big money is investing on the downswing. I think, listening to Morris about what inflation will do makes perfect sense to me. He's describing a cold bucket of water on the industry, but implicit in inflation is that if you're deep invested in New York City assets, they too will rise in value because they're going to float with inflation. So cold bucket of water, yes, definitely makes perfect sense for the next year, but long term with big players, with tech players coming to New York, I think you want to be in real estate in New York long term.
So I'm just going to say one thing that isn't a macro analysis. I see people who are coming to me, to us, I didn't mention Elliot. I gave a shout out to everyone else from my team. I see guys who are New York developers who've gotten their feet wet in the Bronx, who are doing stuff in Brooklyn, and who are just diving in head first into these states. They're not checking to see if there's even water in the pool. Some of these guys are going to get smoked.
Oh yeah.
They are going to get smoked. If you guys are starting your careers and you're going to go start working with a developer who is, never bought anything in North Carolina, never refied anything, never sold anything, and is going to buy 500 units, make sure you're not investing equity in with that person. So to me, I see guys, they don't understand the market, they don't understand what they consider to look like. They're used to the Bronx where they just they are open the front door and they have a tenant waiting for them. I'm nervous, and again, not talking about the long-term viability of New York, which I think is arguable to some extent, and that's just.
I could jump into that for a second, because we have experience. So a bunch of the stuff that we've done in South Florida, specifically, we've done with local partners. People that live there, that work there, that know the players there, and I'm actually a replacement, right? Eddie didn't originally invite me to be on this panel.
I complained when he showed up.
Yeah, he invited my brother AB, my partner, to be on the panel, but like Z said, you have to get involved in the markets that you know, and we get involved. We get involved. One of the ways we get involved is politically. And my brother Abe's actually meeting with Mayor Suarez, who's the mayor of Miami, today, so he had to be there. So I'm filling in the center, which is like a home to me anyway, like many of you know. But that is important, to have a local partner, to have a presence, to get in the know with the people that are there, and to feel comfortable in that market, and not just be fly by night and jump in without really understanding it.
Yeah, but hold on. I had a question on what you said. Sorry, I don't know if I'm allowed to ask questions on the panel.
Of course.
My question is-
They're supposed to ask the question.
I don't know. I'm gonna ask a question. Just listen in.
Did we script this?
No, I don't script it. I have a problem.
It's all
Okay.
good.
My question is as follows. In 2020, pre-COVID, you had all this housing stock. Florida, Miami, right? You mentioned all over the red states. They trade at what cap rates? ACAP? ACAP, right? Fair? ACAP.
I don't think they were trading at
Seven.
I think a lot of it
Seven?
depends
I'm not
on
talking
the
about
market.
Miami proper. I'm
I
talking
didn't
about
know there was-
Georgia.
I didn't know there was ever such a thing.
They were.
I think you're talking about garden style.
Correct.
in
Garden
Georgia.
style, I'm not using you as an example.
Yeah.
Garden style apartments are trading at 8 caps on a good day. And they barely traded, and if they traded, they traded. Great. Today, what are they trading at?
Yeah.
3.5 caps, 4 caps. So my question is, what changed? I get it, population shift, population growth, red states, but how much? What'd they grow? New York State lost 1 assembly seat. It grew 100,000 people, 200,000 people, 1 million, which are not even that much. Certainly not enough to justify an 8 cap to a 4 cap. Meaning, in my thought process, I agree with Z. I think it's, and I'm sorry that I'm Debbie Down, I think it's gonna crash epically, fire, flames, burning to the ground, because there's no reason to explain how somebody went from an 8 cap to a 4 cap.
We have a loan today that we were looking at, that someone's buying a $20 million property in a new market to him.
Yeah.
He's paying $75,000 a unit. They're not global units. 30% of them are like burned to the ground. He's paying $75,000 a unit. The comps from last year
Yeah,
are $40,000.
that's the problem.
And-
No, but my thought process, what?
I mean, we're giving him $65,000. No, we're not.
No, but my question is what justifies that? So I understand that there's population growth, but it went from an 8 cap
It's
to
people
a 4
used to
cap.
paying 4 caps. They go, oh, I used to pay 4 caps on stuff that B6 was selling me and
Correct.
for the rent stabilized. I'm going to go into I can get 4.5 cap in South Carolina.
I think
Awesome.
there are other factors. First of all, new product does always demand a
$1,000 a unit. They're not global units. 30% of them are like burned to the ground. He's paying $75,000 a unit. The comps from last year
Yeah,
are $40,000.
that's the problem.
And-
No, but my thought process, what?
I mean, we're giving him $65,000. No, we're not.
No, but my question is what justifies that? So I understand that there's population growth, but it went from an 8 cap
It's
to
people
a 4
used to
cap.
paying 4 caps. They go, oh, I used to pay 4 caps on stuff that B6 was selling me and
Correct.
for the rent stabilized. I'm going to go into I can get 4.5 cap in South Carolina.
I think
Awesome.
there are other factors. First of all, new product does always demand a premium to older
It's
product.
not new, it's
And
old junk.
I agree.
Some
I
of the
agree.
product, it's hard to talk at a macro level, right? Because garden style in Georgia, we're not looking at a specific asset, and sometimes you have to really dive into the details to understand why something is driving a better price than something else, and that's not.
No,
my-
I don't disagree, but I'm saying the same exact product was trading just because COVID came and then people shifted assets away from New York there. And then there was a rush to yield because they said, I'm going to buy from Paul Massey, I'm going to buy a 4 cap in New York. Forget that. I'm going to go buy a 7 cap and I'm getting a 3% load from HUD. That's going to finance me at some ludicrous valuation and I'm going to get a 20% return. But now when those rates from HUD are now what, 5%, right? What are they, 5% today?
Yeah.
That same guy is dead. It's impossible that he can make money. No.
Don't buy garden style in
If
Georgia.
he
I don't know what to tell you.
if he has 30-year money, 40-year money that's locked at that rate,
Yeah, sure.
all right, he'll be okay.
Hello, stop trying to sell your product.
These kids don't qualify. Come on.
All right, so
It's not a knock to you. I'm sorry if it came off that way. I was just saying in general. On the whole industry, I'm very bearish.
I love you.
I was helping him
Oh,
out.
man.
So
Well,
it's
he
amazing.
doesn't.
I don't buy garden style apartments.
I know, you buy profit.
So we'll just move on to one question specifically tailored for each panelist, and then we'll open it up to a couple of questions from the crowd. We'll start with Paul, my boss. A little bit of background. Paul Paul started in Massey Knackle back in the 80s with his partner Bob Knackle. It was the &1 investment sales firm in New York, meaning selling any kind of investment property, basically anything that's not a 1 or 2 family house. And it was #1 for decades. Selling 200 plus properties a year at a point. So, back in 2015 when I was actually there, they sold the company to Cushman & Wakefield, big global corporate company. So, Paul, I'm kind of curious what key takeaways you have from your experience in building Massey Knackle, in selling Massey Knackle, and then starting B6, as well as any keys to success that came in with those.
So many. So grew up in Boston, got a summer job at CBRE, big national company, and loved it. Never knew anything about real estate, and went running back there as I was graduating from school. And the boss was this crusty guy who was like, "Look, the office is full. I have one opening. I'm not rolling the dice on college kid." And I had gotten the summer job that I had in the Boston office through someone that I met at school in our fraternity. And I went running back to him saying, "They won't hire me in Boston. I'm crushed. I really want to work for this company." And he's like, "That's the bad news. The good news is we're brand new in New York City, and we'll take anybody down there." So my plan was come to New York for 6 months, go back, work and impress them, and go back to Boston and get the job I really wanted. The minute I got here, I fell in love with the place completely and utterly, and just was so happy. And CB was very paternalistic and great. And so we worked 5 years there. I met the guy that I started our first business with, Bob Knackle, and we fell into this little niche, and we just were happy for years and years. And part of it was New York City was not institutional and organized. The big players really weren't dug into this little niche of selling buildings and financing them, which is hard to imagine because they have so much value and they contribute so much. 40% of New York's budget comes from taxes directly on buildings. So it's a big part of New York. And we had a great time. I mean, I could go on about lessons from ending up in a lucky place in New York, but I'm grateful. And we have so many friends here tonight, and so many people we've done business with. And I don't know how to answer, but happy, lucky guy.
Awesome. Morris,
Yeah.
I'm kind of curious about your inspiration and the early days of KSR, how you built it up into what it is today, the journey along the way into building such an incredible company that I spend a lot of time at from Chad every day.
Yes, we see every day.
And I see all the action and the
Do you go twice a
enthusiasm.
day? Just want to know.
What was it?
Do you go in the class twice a day? We see him sometimes by us too. I've heard how many classes you go to a day.
I rotate.
He's
Networking, he's smart.
Yes, so just what went into
Sure.
it and the process.
So first of all, I'd be lying if I told you I had the vision. I have no vision. Just want to make that clear. I still have no vision. We follow the money. We fly by the seat of our pants, and wherever God takes us, that's where we go. So I can tell you, KSR didn't exist at one point. We were in residential doing furnished apartments. So that was basically we would lease in bulk units, furnished apartments, and then we'd release them out to corporations as an economic alternative to hotels, called Airbnb before Airbnb. Okay, and then 1 year, all my friends were going to ICSC. All I hear about is Vegas, Vegas. I'm like, Abraham, we gotta go. My partner, like, we're gonna go. It's like, but we don't know anything about retail. Like, so what? We're gonna go. So we got some guy to give us like 4 retail exclusives that were probably the worst retail exclusives on the planet. Probably wouldn't take them today. We go to Vegas, all amped up, no company name. And we're going booth to booth to booth. And if you go to Vegas, you understand, you book appointments ahead of time, you have a full calendar. It's not like, like a trade show where you want to buy, like a stick of gum or something. No, you have to go and have appointments. So I'm being turned down everywhere I go. Finally, I go to T-Mobile, shut me down. I go here, there, everybody shut me down. So now I'm dejected. I go at the time to Subway Sandwich Shop, which at the time was the fastest growing retailer in the country. Same thing, sorry, we have no appointments for you. I'm like, all right, that's it, it's over, we give up. So now I just go, just do me a favor, tell me who's the owner, so at least I know, like for future reference, because that guy at the table, he's the owner. I say, okay. sitting there, I'm waiting on the side. His meeting's getting up. I grab my partner, Abraham. Come, we sit down at the table. I say, hi, I'm here for the meeting. Guy looks at me, he's like, okay. He goes, all right, so what are we meeting about? We're the #1 retail brokers in New York City, blah, 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 BS, BS, BS. I don't know what else saying. Guy looks at me like, okay, what's your company name? I got no company name. As I'm talking, the guy whose real meeting is walks up and, he's now hovering. I look back, I'm like, hey buddy, can't you see him in the meeting yet? Guy turns purple, walks away. Now he's like, all right buddy, the jig's up, what do you want? I'm not getting out of this chair until you give me an opportunity. I refuse, call the police, I'm not leaving. Guy goes, all right, fine kid, 125th and Broadway, go get me a relocation. I said, okay, fine. Gives me his email. I said, no, give me your number. Gives me his cell phone number. I'm still sitting there. He goes, why are you still here? Dialing the number. You know what? I've seen a lot of women give me fake numbers. I'm not giving a fake number. I call the number. His phone rings. I leave. Thank you very much. The next 2 weeks, we spent, my partner and I called up every building in a 4-block radius. So a 4-block radius means 4 blocks every way. Every single building we called up, and we wanted to make what was available, what wasn't available. So then I sent him an email 2 weeks later, 30 spaces. Guy calls me up in like 30 seconds. What are you wasting my time for? I personally canvassed it. There were only 6 spaces, blah, 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 yelling at me. I said, look, this is what I did. I called up every building. I found that guy would sell his business. That guy has an eviction clause. I got you 20 spaces, 16 are off market. Guy goes, wow. He goes, okay, I like you, kid. We're gonna do a lot of business. So that year, we're like, all right, maybe now we actually have the company name. So we opened up the company, and then we ended up running, I think we opened up like 40 leases with them that year, and that's how the company was born. The point is, it's honestly, there was no vision, there is no vision. At the end of the day, I told you before, we pivoted into industrial. We pivot throughout, and as far as I see it, is that dinosaurs die for a reason, because they don't pivot. And the markets change, technology changes, patterns change, and you either change with them and leverage all those relationships that you've built and the successes that you've built upon to grow, or you die. And that's really what it comes down to it. So the advice I could tell you is that everybody seems to think they have to have a 5-year plan, a 10-year plan, or whatever plan they have to have. I can tell you any plan I ever had probably failed, and any plan I probably didn't have probably went into fruition. Because who are we to know what's gonna be? We're giving you predictions in 2 years. For all I know, 2 years, the economy will be hotter than ever. I don't know, but I do know that at the end of the day, if you're nimble, if you listen to a lot of people that are smarter than you, if you talk to people, if you network, and if you run a good, honest business, there will always be business for you going. And that's how you have to do it. So that's my thought process. Thank you.
Amen. Ezra, I'm kind of curious about, you used to be on the investment side, with Duke Properties.
Yep.
You were in investments, you did some syndication. How did you transition from that into the private lending business that you're in now, and then what went into that decision, and how was that process?
Okay. So, since I don't have to pay you guys $300 an hour, but I'll still use you as my therapist for this one. It was an interesting thing. We were playing a lot of the rent stabilization game. I think it was in like 2015 or so when they tried to pass those rules, and I said, this is not going in a good direction. It was 2016, not going in a good direction. I also hated syndication. I think it's an upside down model. So for those of you who don't understand what syndication is, you go to your friends and you tell them, oh, okay, I need to buy a $3 million building. Okay, we're going to borrow $2 million and we need $1 million of equity. Well, we don't really need $1 million of equity, we need $1.1 million of equity because we have to pay ourselves. So now you've raised $1.1 million from your friends, and the $1.1 million is all of a sudden is only worth $1 million. So you're now 9% in the hole and trying to dig out of that. And you heard Paul mention what a pain in the ass it is to sell buildings in New York, right? And the rent stabilization game, rules are getting harder, and you have this long view of, okay, in 5 years everything's great. So I had a bit of shell shock from that, a little PTSD, and started on June 6th, 2017 with the OBEDs. And it was an interesting thing because it was we had a blank slate. So I was kind of working on June 6th, 2017 with the Obeds, and it was an interesting thing because we had a blank slate. So I was kind of working at the syndication shop where you're always tight for money and you're like scrambling and need to do a deal because you have to pay the bills and keep the lights on. And Joe said to me, Joe Obed, he said, don't worry about anything, take your time. If you don't do anything for the next 2 years, it's okay. The salary is significant for you, but like as an organization, we're not in a rush. I said, oh, okay. We don't have to pay to keep the lights on. Okay. So I don't have to pay to keep the lights on. I don't have to ask my friends to give me $100,000 now and promise them I'll make a return later. And how can I not think about, worried about like, oh, and you'll see something in 5 years from now. So, by the way, I also love structured finance. I love playing with numbers and I love building businesses. So this debt thing was really interesting. We went and kind of did the opposite. So I'll give you a short version. We said, okay, I can do a loan for $3 million, okay? And I'll do that loan for $3 million, and I'll get $2 million of debt on my loan. So I'll go to a bank, and they'll lend me on my loan, okay? So I now have borrowed $2 million, so I'm making a $3 million loan, and I only need $1 million, okay? Now I'm gonna collect an origination fee on that loan, okay? So the origination fee is gonna be 2%. So that's $60,000. So I need $1 million, right? So I told you I needed $1 million before, but it wasn't really $1 million, it's $1.1 million, give me the $1 million, give me $1.1 million, it's really only worth $1 million. Now I go to my friends and say, okay, look, I need $1 million. Like, okay, here's the check for $1 million. I said, you know, I don't need $1 million. I only need $960. What do you mean $960? You have origination fees that are getting paid right away. You're in good shape, don't worry about it. They say, okay, sounds good. Are you in for it? And the Obeds were great. They're like, we're going to be in for at least 20% of every deal. We don't want to be syndicators. We want to be in the deals. I said, and guess what? We're not going to take more than 20%. So generally, we don't let anyone put more money in than we had. So we were the biggest investor in every deal. And then I said, there's no G&A, and we don't make a return until you make your money. So we told people, and there's no like 5-year story. It wasn't like, okay, in 5 years from now, you're gonna double your money and everything's gonna be great. No, here's what it is. It's now July 17th. If you don't get a check from me for $1,083.33 in, what did I say, July, so the rent is paid in arrears, August, beginning of September, something has gone wrong. And I don't have any excuse. So people didn't have to wait 5 years. They said, okay, you told us we're going to get $1,083.33. It happened. Great. It's happening. Okay, how can we do more? And then the reality for me was, Joe and I said, okay, how do we create a business where we don't have to do too much work? And I love figuring out the numbers, going to buildings, much less. So we said we can scale a business. We'll bet on good horses, and we'll find the guys who we believe in that will go and be be the guys that we invest with, except they're going to have personal guarantees. So look, I mean, out at the end of the day, after we have after we've borrowed on our loan, our returns are equity-like returns. So we're getting personal guarantees, getting paid monthly, and we were able to scale. So if it was just two of us in the beginning, how many deals were we able to do over 5 years? I don't know. How many deals a year? You can do 5 deals a year? 25 deals? So we did 1,700 deals so far, a little over 1,700. And you know, we've done it. Obviously, it's not just two of us anymore. We're 60 people. But that's how it started, and we have an amazing team, and we're very, very grateful. Yeah, so.
We're really pessimistic on this panel. Because that same guy who bought the building for 3, put up 1, borrowed 2, sold the building for 6. That 1 became 4. He still got back 2, or 2 and change. I just wanted to throw that out there. So just FYI.
So
That's a valid
Pays to
point.
be in both seats.
That's a valid point.
Yeah.
That's
Yeah,
a valid
I was going to say,
point.
we did have one guy who, this is like a word story, it's worth it, where when it pays to be the equity. We had a guy, he was doing condo roll-up, whoever follows me on LinkedIn, you may have read about this, condo roll-up, and he says, I have this condo play in Connecticut. I'm very excited about it. These things work as condos, but they work much better as multifamily. There were 176 of them. said, okay. He said, I'm going to try to buy as many as I can. And he bought 20, and we financed, and we bought another 20, we financed. So I think we were getting like 80%. And at the end of the day, he bought, I think, all 187 of them for, it was about $11 million, 11 and change. We gave him $9 million of it, and he was in for 2 and a little bit. It shifted the way the world looks at fractured condos. Nobody likes fractured condos. Even the word sounds bad, right? Fractured condos. But when you have multifamily, everyone's multifamily is exciting. So he turned this fractured condo, built garden sample complex into a 187 unit multifamily garden sample apartment complex, and he sold it for a 5 cap. And it was within the whole thing from our first loan
What did his $2 million
till the end.
There you go, that's
What
the
did his $2 million mean?
How much did you make?
He sold it for $25 million.
And you're 9. You got your 9 back and your interest.
We made $200,000 on the deal. Net to our pockets. It was great.
Who wants to invest the $2 million with the sponsor?
And that guy is, so yeah, I get it. We did 1,700 loans, and I have one story like that. I don't know.
There's a lot of ways of making money in this business.
There you go.
I think that's the takeaway that
For
you
sure.
guys. Eddie, I don't know if you had a specific question.
I did.
All right.
Sorry.
I don't think they want to hear from us anymore. They probably have their own questions.
I agree.
Yeah, so I mean, we could go straight into the questions from the crowd.
Yeah.
All right, so whoever has a question for any of the panelists specifically, or if it's just in general and you want any of the panelists that feels comfortable taking it, feel free. So just feel free to raise your hand and ask anything that's on your mind. Charles?
How have you guys realized the return on investment with government paying rent, be it Section 8, be it HUD? Have you realized the return on investment of dealing with the government paying tenants rent to be more profitable or more of a headache to deal with?
It's a good question.
I don't have any.
I'm not in that business.
So I'm not in that business, but we touch it, right? So the guys who give the personal guarantees, they collect the rents. And what we've noticed is they love it. They love it. The Bronx specifically, they say, look, we don't have to chase tenants. This whole, how someone loses their job, they get Section 8. Not only that, Section 8 is paying over market rents. And in my opinion, Section 8 is doing a terrible injustice to cash-paying tenants in the Bronx because they are setting a market rate that would not be there were it not for these programs. So I mean, from the perspective of the people who are receiving Section 8 vouchers, it's good. From the perspective of people who are receiving or getting the payments of Section 8, generally it's good, and they actually keep their apartments in better condition than cash payers because if they don't keep it up, Section 8 won't pay them. But to me, for the neighbors of the Section 8 tenants who are going out and working hard, not so great.
Very interesting.
Any questions?
We touched on triple net leases, and we touched on interest rates. Interest rates are climbing up, but those triple net leases are kind of stable. Sometimes they're frozen, for 20 years or for 10 years. What do you think of the prices of those properties, the triple nets? Do you think they're going to fall?
So, how about this? I'll answer your question with the fact. We're selling right now 2 triple net things that we own for that exact reason. The rents are flat. We have a CVS and a Tire Hub, one in PA, one in Albany. And the rents are flat, and therefore it's going to be a declining asset to inflation and interest rates. And we're selling for that reason. And I think that sector is purely, and I mean purely based on interest rates. There is nothing else. They want to buy a stable return, usually triple B plus or better credit ideally is investment grade, so therefore they get the best financing, and it is purely based on interest rates. So when interest rates move, they move. And at the end of the day, it will unequivocally be affected. The cap rates will rise, and they will go down in value. That's the fact. Because it's not the person buying it is a 1031 buyer predominantly, who is not a sophisticated investor and is buying it purely for the yield. No reason. He wants to buy a CVS. He doesn't want to have any responsibility, doesn't want to be a landlord, doesn't want to get a phone call, nothing. Give me my rent, I will pay my mortgage, have a good day.
And therefore, that bucket of capital is solely dependent on interest rates. It's gonna tank. Not tank, or just change with interest rates. It'll fluctuate accordingly.
Do you see a lot of your investors have a mixed portfolio, multifamily homes, triple net leases, industrial, like,
No. I find that most people that have triple net leases aren't real estate investors per se, unless they bought them in bulk for whatever reason, but rare. Like ours, we repositioned it. It was by default, it was by accident. It wasn't like we bought it and that's what it was. We made it into that. So I find that most people that own it are usually people that aren't real estate professionals, and therefore for them, it's a safe haven for their capital. They sold a home or sold a building, and now they guarantee a return. It's like a retirement plan. That's been my experience.
I completely agree with Morris. I think there's irrational exuberance in the triple net world, and if you're a New York City owner and you've had a property long term, your basis is small, pay your taxes. Don't roll the dice again.
Look to the bond market. You're effectively buying corporate bonds, right?
On my pen.
Does anybody else have anything that they want to ask any of the panelists?
What happened? Is we weren't interesting enough for you? You have no questions?
All right, if not,
Morris will stay behind to talk more. If anybody
I
wants.
will talk more, no problem. What do you got?
Michael.
Are we heading towards a recession? And if so, how does that affect real estate? How does that affect how people underwrite multifamily industrial deals and things like that? Are you guys scaling back a little bit on your investments and holding still on what you have?
You want to talk, because you're more optimistic.
Yeah, I'm very optimistic. I think, you can have a recession. I mean, the inverted yield curve points to a recession. It's never wrong. It never missed a recession, but sometimes it points to things that aren't there. So it doesn't mean there's going to be a recession because you have an inverted yield curve. So for us, we are dialing back leverages. So you guys know that, right? We're dialing back leverages a little bit. So where we were at 75 on some deals, we're going to end up at 70. We're going to look to rent growth be, everyone's talking about runaway inflation. We're not going to assume that. If there's a recession, it's not the best thing. I would imagine something gentle, unless there's unless Putin starts dropping nuclear weapons, then all bets are off.
Wow. All right.
We can't end on nuclear weapons,
Wow.
right?
It's not optimistic way
I'm
to
gonna
end.
call out Morris Sabbagh for a second. I have a question.
Go ahead. Oh, boy.
So, I've known Morris for I don't know, for like 10 years now.
Yeah, long time.
And I'm a fan. I'm a fan of Morris Sabbagh.
Thank you.
I'm happy he's moving to MUJ area, so we
Yes,
get
very
him over
excited.
there and leave you guys over here in MUS. Good to know.
Very
So, you talk a lot about not having a vision. I've heard you mention that. So I think that I think Abraham left, right, when you said that, or maybe a little before. So I've watched you for 10 years and before that, and I think that your vision is, so what Morris, I think, does, and you can ask him about it, and maybe is you spot, you talk about pivoting, right, but you spot opportunities. And you say, okay, there's something here where I have this asset, that asset, and assets don't necessarily money, maybe it's skills, maybe it's network, whatever it is. And I have these assets and I notice this opportunity and I'm gonna go and seize it and build a business around that. So it might not be and here's what's gonna happen in 5 years,
Sure.
but it's always, and here's what's gonna happen now. And I think that's, for me, and that's why when I want advice, I'll go to you.
Thank you.
And I'll say, okay, Morris, here's the situation I'm in. What do you think? So I just don't want to leave it out there that Mark doesn't have vision and he doesn't make plans. I mean, the guy is the bestest thing. I mean, you hear him talk. He's just talking so fast, and his mouth is trying to keep up with his brain.
Hold on, what's the question?
It's not a question. You can answer that however you want. It's a rhetorical question. So what do you think about that?
It's also important to point out to this audience specifically what Massey did back in the day was, and now B6, by breaking down into the territories is really an important message to everybody. You pretty much told the groups, study your area, learn it inside and out, right? Canvass the streets, know the owners, know the renters, know it like the back of your hands. And you'll become the expert. When you're the expert in that market, they're always going to turn to you before they turn to somebody else to be the spokesperson for that network. And that's really what put every one of your agents ahead in their own markets. And I think that's a great lesson for anybody getting into not only the real estate business, but any business they get into. Learn it well. Don't be half in and half out. Jump in with 2 feet, educate yourself, immerse yourself in it, and you'll work hard, you'll be successful.
To just highlight what you were talking about there, for a little reference, I'm currently toward the end of the process of taking 1,500 pictures of buildings in my territory, which is part of our agent training that every single agent, even the guys who have been doing this for decades, do, which goes to show, what Stephen was saying, get to know your market or your niche, whatever that is, inside and out, which obviously Massey always did, and B6 is doing now. And yeah, it's an awesome lesson.
Wow.
Thank you, Eddie.
All right, thank you so much, everybody.